Hi, David.
Hello, Marie.
How are you doing?
I am great, Long day today, but I'm excited to have this discussion with you.
Okay, okay. I guess I've never seen you before. I guess you've never seen me before. So
Not in person, no, but I've read about you.
okay, I see. I see. So I'm here that we're supposed to chat today about some exciting stuff.
Yes, Anatoly had asked me to be one of the people to hold a conversation with you. We're talking about pension funds in Jamaica. We've been hearing a lot of reform is going on, and people like me, Jamaicans in the diaspora, have a number of questions that we'd love to get some answers to. So I hope that you will engage today.
Okay, I'll try my best to answer all of the burning questions.
Yeah, well, I'll start with an easy one. How about a softball question? What's your background? Where do you work right now?
So I work at Scotia Investments. I manage pension funds and unit trust funds and mutual funds. My background is quite interesting, though. I am an economist by training, went to University of the West Indies in Jamaica, and I am a CFA charter holder. And my previous life, I was a utilities regulator.
Wow.
So I never grew up in banking at all.
So how did you get into banking and the investment world as an investment manager?
Well, I guess for me, the CFA was the platform. So I did the CFA examinations, and then I kind of charted a course to get into the financial industry by focusing more on research first, and then segue from research into portfolio management.
So you mentioned that you work with a different amount of investment products. And there are a lot of people who probably don't understand the difference between a unit trust and a mutual fund. We now have index funds. We're hearing about these things. Can you just give us a high level overview of what's the difference between those?
I mean, in Jamaica, there's really not much difference. It's really a pool of money being managed by an investment manager. Our regulation describes a unit trust fund, which is more local, and a mutual fund will tend to be those developed overseas and sold in Jamaica. So like your CI funds, your Scotia funds, your Manulife funds, those are mutual funds. But when you move away all of the fancy jargons, pool of money put together by investors, they hire an investment manager or portfolio manager, manage it based on a prescribed asset mix, prescribed objective, get a return, that's it. You can buy into units, you can sell units as you go along on a daily basis.
Right, so it's a fund is it publicly traded, or can you have funds that are also publicly traded that individuals can participate in?
So in Jamaica, you really don't find that our unit trust funds are publicly traded. In the more developed markets, like in North America, you find that those funds are more listed and traded, I guess, to make it more liquid. Persons can get cash as easily as possible. But even though it's not publicly traded in Jamaica, the portfolio managers behind the scene, or investment managers, will facilitate purchases and sales on a daily basis. You get your money if you're redeeming in 2 days after you have put in your order to in cash. So it's a similar mechanism, just like your pricing and the liquidity or the visibility is not as...
It's not the same.
Yeah, as the North American market.
Well, and so you are vice president, I believe, of the Pension Fund Industry Association. Assistant vice president.
Yes. And I'm a director of the Pension Fund Industry Association of Jamaica.
Okay, so are there any plans to have it become even more liquid and transparent, similar to the North American markets with some of these pooled investment vehicles?
I think it's a function of each of the investment managers and security dealers that offers their kind of products. So you may find that probably a Barito or Mayberry or JN or Scotia may have different objectives, and that will guide whether they want to list and make it publicly traded or not.
Okay, no, that's great. So since we're talking about the listing part, we recently had 2 listed equity funds in Jamaica from Sagicor, Select F for financial, and then we have the manufacturing one.
Yes.
do you expect more of that to be happening in the market going forward over the next 5 years or so?
I think it's a function of the dynamics of our market. The two funds that are listed by Sagicor now, they selected the indices that have a lot of the stocks that are more liquid, that is more traded on the market, have larger market cap size. So it makes sense to, if you're creating an index or exchange traded fund, you select the stock that you can adjust based on market capitalization. Right. If you move to the sectors that is not as frequently traded, like your retail, you may find that it does not really add much value to an investor. Also, if it's a case where you have more of these kind of funds and they're more passive investing, meaning that you just follow an index, the stock price go up, the cap goes up, you buy more, it goes on, you sell, then it's not really adding value to an investor, just a branding, a different company offering it, but it's a similar kind of return because it's passive investing. Whereas in the North American market, you have a lot of indices and sub-indices and industries and sectors. So the ability to develop more of those unique kind of funds is greater.
So what you're saying is that in a broader market, it is easier to earn your keep as an asset manager than in a market like Jamaica, where it's a smaller section, smaller subset of those businesses where you say you can add value, because you don't want to charge somebody a fee when really all you're doing is actually following an index.
Correct.
So I love that you're talking about passive investing for the people who are watching this, who are new to investing and they don't understand the difference between passive and active. How do you define that when you are talking to a group who is just learning about that financial literacy, just getting into the investing world?
So I'm going to probably use passive investing and an active investing, like you have a car. So you're driving a car and you have the economy mode and you have the sport mode. So the economy mode is where you're kind of on cruise control, you're not really overtaking, you're just driving at a normal speed, probably cap how fast you can go. So that is where it doesn't require a lot of sweat, a lot of sleepless nights. It's just nice and smooth and easy. And a portfolio manager's work is to look at the index that it matches, or it's following. If the index value changes or the amount of the assets in the index change, you sell and you buy. And that's it. Whereas for the active management, it's where you're in the sport mode. So you always have to be adjusting. You're adjusting your gears, you're adjusting your assets, you're deciding whether or not you buy this particular stock. I mean, everybody may be selling, but you want to buy because you have a different view, because you're convicted about that particular security. So that is really the difference between it. So what you will find happening is that with passive investing, it doesn't cost as much. You don't pay a portfolio manager as much money because they're not really doing a lot. Right. With an active investment, because the portfolio managers to get their analysts to follow the market, follow the market all the time. There are a lot more costs involved because you're buying and selling more actively. They charge more for their services.
Oh, that makes sense. So before I launched Blue Mountain Capital, I worked for a hedge fund. This was a long bias fund. So we were active managers and we charged a typical 2% management fee, 20% performance fee above our hurdle rate. Is that similar to the way active management works in the Jamaican market, or is it different or different fees?
For active management, no. For the most part, the management fee is usually about 1.5% to 2%. You don't have that 2-20 split. Over the last 3 or 4 years, though, we find where new funds are coming in, like your Cygnus Credits investments, where they have the split.
Right.
The 2%, 20% above a hurdle rate. You may have some alternative investment funds. I see where MCB is looking to launch a Stratus fund. Yes. So you may have that kind of split to kind of provide more avenues for the general investing public. But the traditional unit trust funds and mutual funds, it is like a management fee, and that's it. So you tend to find that similar to your background with a hedge fund, the 220 split is more for the alternative investments than your traditional fixed income equities investment.
And so I love that, getting into portfolio mix and portfolio construction. In Jamaica, thankfully the rules are starting to change, but we've seen conflicting information between FSC and BOJ for what percentage of a pension fund can be deployed into foreign securities. I live in the United States. This is a great market to invest in, and I believe there's always a home bias. In the US, the majority of Americans have a US heavy portfolio and miss out on the rest of the world. In Japan, for some reason, they have a Japan heavy portfolio, which it wouldn't do so well. Jamaica, obviously the same thing. We have a Jamaica heavy portfolio. Why is the first question, part one. Why did we have such a bias to what only 5% of pension fund assets could be invested in foreign securities? And then what is the plan? Are we going to get to 20% I know we're at 10% now, I believe?
So I'm going to answer your question in a very roundabout way. Disclaimer. I agree with you that you tend to find that the different jurisdictions, different countries have home biases. They can see, they can feel, they can touch, they're comfortable, they can protest, they want justice kind of thing, so they tend to do that. In Jamaica, I guess I find that with smaller open economies, those that rely on the larger developed economies for their trade, is very remittance dependent, very foreign direct investment dependent, net importers of goods and services. You tend to find that they have a lot more control over investing in foreign currency assets than those that are net exporters, those that can print US dollars.
Right. Yes.
So you find that happening. So even persons would probably think that, because we have a low credit rating, why we have this restriction. But like a Trinidad, which is an investment grade credit, they also have a restriction on foreign assets. Because I guess they can't print all the other currencies except their own. So there's only a form of control on it. I guess the debate is whether it should be 5%, 10%, 25%, 30%. And I think that the percentage is a function of how advanced these developing economies are in their economic state. So for a very long time, as you know, we were struggling.
Very much.
We seem to settle off now in a steady state, but we're not really taking off. And as such, there's still some element of control. What we would have seen over the last 5 or so years is that your unit trust funds had a little bit more latitude to invest in foreign assets. So their limits moved pretty quickly to 25%. And the Bank of Jamaica, which has overarching responsibility for foreign currency, exchange rate, etc., they would have indicated that they will get to the pensions industry later on. Now, the pension industry is a significantly larger asset pool than your unit trust funds and so on. And as such, I guess it would have taken a little bit more time to fly the gate for a pension. The pension size now is around $640–50 billion. But if it moves to like 25%, that's some serious chunk of money that's going to chase the US dollars. That, if you look at it now in a crisis where, remittances are okay, but the foreign direct investments is not really coming in. We're not net exporters of goods and services. We don't have a lot of natural resources like oil and gold and copper and those things to generate that inflow. So I guess it's a little more time for them to release the limits. In recent time, as recent as October, they have indicated a plan to move it to 7.5% effective November the 1st, and eventually move it to 10% April of next year. And then after that, I guess they will see how the market dynamics change before they decide to make any further adjustments to it. I think from the Pension Industry Association, what we understand the macroeconomic consideration. because we all live here, we're going to retire at some point in time. So we have to be, I guess, measured and prudent in how we clamor for change. One of the challenges is how much flexibility we get with what we have. So as you know, it is restricted to investment grade, not investment grade, US, UK, Canada assets issued by governments. So you may have a fantastic company doing excellent, can't buy their stock, can't buy their bonds. As close as the Caribbean is around Jamaica, you can't buy Trinidad assets. You can't buy Bermuda assets. Even though they're better credit quality, the economy is better. Some might debate it, but from an economic standpoint, they're better than Jamaica. We can't buy those assets. We can't buy equities. Maybe more liquid on the US stock exchange, but we can't buy it. So it requires, even if the limit stays at 10% for a long time, it requires a little bit more assessment as to what level of flexibility an investment manager or trustee will have to buy different kinds of assets to meet their pension objective or meet their unit trust objective.
That is really interesting. So to me, as someone who is an investment manager as well, it sounds like you're a bit handcuffed to the pension fund industry in Jamaica. But we understand why.
Yes, yeah, we're more handcuffed in the pension fund side than on the unit trust side.
And the unit trust side.
So the unit trust side, it still requires you to invest in an investment grade kind of credit, but you can invest in corporates, you can invest in equities once you meet the criteria. Whereas for our pension fund, we are not there yet.
Not there yet, but I like that you use the word yet. That's the important word to someone like me. So another part that I definitely wanted to discuss with you and get some feedback and get the question answered is that in North America, where I'm based, pension funds, CalPERS and these large companies, right, teachers unions, police unions, invest in alternative assets as well, not just stocks and bonds. So they're not just doing this traditional 60-40 split that most of us are taught when we start off. They are investing a significant chunk, 30 to 40% in venture capital, in private equity, and in hedge funds, and even they might put real estate in that side of things. Jamaica recently made some changes to make it easier for assets to be put into venture capital, private equity. What is the state of that?
I think we have started
right
by doing a carve out for investments in these alternative investments. I think that there is still some element of discussion that is required to determine whether the initial carve out is the most appropriate. And the reason why I say that is because I think initially persons were saying that we can just buy private equity, not realizing that the carve out is for equity and debt of private companies. So
that's not the same thing.
It's not the same thing.
Not at all.
It is not the same thing. So if you buy a bond from a private company, call it Marie's Auto Parts, that eats into your 5% allocation that you can look at for a hedge fund or a private equity fund. So it is really 5% carve out to equity and debt of private companies. I think that whilst most of the local landscape is sufficiently comfortable with debt, fixed income assets, I think persons are tipping their toe in the water for the other sexy kind of assets.
Yes.
So I think that's where a lot more investor education is required. So they can better understand the risk and the return, because somebody will see, oh, I can get like 30%, and they say, woo, I want it. Not realizing that there are a lot of other downsides.
A lot more risk. The risk-adjusted returns is what I always tell my friends when they talk about getting returns. The risk-adjusted returns are what matters. Don't come and tell me you got 30% when you had the chance of losing all of it. That is a huge problem versus, and I'd rather take the safe 8% that I couldn't lose anything. So a lot of us know, and so that's something you have to do all the time. Especially you did your CFA and you are an asset manager, pension fund especially, are for wealth preservation, not wealth creation. So you care a lot about downside risk, correct?
Yes, downside risk. I think also for pension funds as well. Generally, you look at the demographic of the pension plan members. So if you have a pension plan and the average age is 25, and you know they generally the profile is that they want risk and they have like 30 years to retire, they can recover again, then that pension fund for profile probably have more the alternative investments, your equities. Whereas if you have a pension plan that has persons who are near to retirement, the average age is like 50. Those persons have sometime already gone through the gate. You have to slow and steady fixed income to get you where you want to get to. So you will find that it's going to be an interesting mix depending on the pension plan you look at. Also important as well as whether the plan is a defined contribution plan. Using fancy term, but all defined contribution plan is that whatever you're given is what you get. Whereas you might have a plan that is a defined benefit plan, where it is not, it's more than whatever you're giving. It's a formula based on your salary, based on the last couple of years that you work with the company. There's a percentage applied to it. So your employer absorbs most of those kind of risks. And you know, if the assets is greater than the liabilities, you may be able to invest a little bit more in risky assets. But if the asset is less than the liabilities, it means that the employer has to go into their pockets
and make up the difference.
And you may find that the employers may say, let's pull back. Let's keep it less risky.
Right.
So it's an interesting mix depending on what you are invested in as a potential retiree.
So in the USA, we have really moved away from defined benefit plans and pretty much is now defined contribution. Where is Jamaica, you think, on that scale? Is it 50-50 to each? Is it more leaning towards defined contribution, or are we still on the defined benefit approach?
So what is interesting with the data is that, and the data came out from the FSC in June, is that you have traditionally a greater number of defined contribution plans, as in quantity, but the bulk of the assets is in a defined benefit plan.
Oh, wow.
So you find that the larger plans are defined benefit plans. I guess the smaller plans are your approved retirement schemes or your IRAs. They are more defined contribution plans. So I guess it will take a longer time for the assets to build up. What we have been seeing, however, is that you have employers considering cutting off at a point for a defined benefit plan and then starting a defined contribution plan, I guess to help to offset some of the employer risk attached to a defined benefit scheme. So you're seeing that gradual shift, but it is not very fast. What happened? Oh.
No, I got a phone call, so they will edit around that on my phone too. And I can't turn it off. That was funny. So we answered perfectly. All right. So defined contribution, defined benefit. We're seeing this mix is being changed in terms of the bulk of the assets. Is that partly because we are living longer as humans? So you thought somebody would only need a pension until age 74, and now they're living till 80. Because you guys use a lot of actuarial science to figure out what yield you need to get. Somewhere in usually the 6 3/4, 7%. So roughly in that range is where you're aiming typically.
The persons that are living longer, data shows that. What you will find though in some of the pension plans is that the vesting period is long. So some pension plans have 10 years, some have 5 years, some have 7 years. Also, you may have what they call, and for vesting period, for those who don't understand, it's the point at which you are entitled to your employer's contribution on your behalf at retirement. Some plans also have conditional vesting. So not all pension plans, because you reach that vesting point of 10 years, you are entitled to your employer's contribution at retirement. If you leave the plan and you take your money, some plans say you forfeit what the employers contribute for you. So you will find that over time, that also helps to increase the value of the assets in the plan. Also, you will find that the larger, healthier plans will probably be more aggressive in equities. that generate a greater return than your fixed income, or they did the shift quickly enough? Because you mentioned before that in North America, there was traditional investing to fixed income, and as time goes by, they invest more in the alternative assets. Some of the pension plans here, I've seen that gradual shift. So in the same data report from the FSC in June, you saw where, and some from last year, you saw where before government Jamaica securities was the bulk. Now you're seeing it shifting towards equities. Perhaps because the stock market did really well in 2016 and persons want to jump onto that train, or perhaps because you have more investor savviness, trustees are more aware, probably the age of the pension members change, could be many things, but you find that the shift is there. So the more you invest in riskier assets that could give you a better return, you may see that the pension plan value is growing faster. Persons leave their contribution, it stays there, it grows.
Yeah. No, all right. So I'm going to put you on the spot, Marie, with one. I hope you answer this one. I can't help but bring it up, right? Airbnb went public just yesterday, got priced even higher than expected. And a pension fund in Jamaica, in my opinion, should be looking at us and saying, if the rules were changed, we could have invested as an LP, a limited partner in Sequoia, and benefit from the Ubers and the Airbnbs that create massive value over time. So would you have wanted to be an investor in a limited partner in one of these VC funds or private equity fund somewhere else around the world to get some extra oomph?
So I'm going to answer your question in a roundabout way again.
No problem.
So I don't think that the rules now limit an individual investor like myself from investing in all of these investments.
Right.
So I think that anybody who is in, so the rules are the rules for the pension plan and for the unit trust funds and for the mutual funds and those traditional regulated investment vehicles. But there is a lot more flexibility for an individual investor. So what I would say is that provided you have the wherewithal, you have the capacity, you have the ability, then complement your traditional investment vehicle and savings with your own personal investment portfolio. Ubers are coming out, Airbnb is listing. I mean, the world is your oyster. You have a lot of online trading platforms. You can even do direct investments there. I mean, explore the opportunities that exist outside of the traditional investing. I know that for your private equity or your LPs, there's a lot more probity around it, a lot of higher investment limits. But think creatively, probably can pull together with several investors and invest in it, as opposed to just saying, oh my God, I can't do it because things are limited.
That's actually a really good roundabout answer. I like that answer a lot. That was really good. I will give you hats off to that one. No, that's great. Well, I don't want to keep you too long, so let me see if I can touch on some more things. You know, for me, I've looked at some of the companies that have listed, some of the types of companies, and then who are some of these investors. So when I look at like a Portland JSX, which is an LP for a private equity fund, but they listed it that allows pension funds to participate. Is that correct?
Correct. That's correct.
And so it's the same way that you would see like a proven investments limited get listed, a pension fund will be able to now invest in that, but get exposure to a number of private companies in the portfolio.
Correct. That's correct. That's correct. That's correct. So you have those traditional vehicles, but an individual investor can easily do their own thing. So they can have the pension fund investing to get the exposure, but also see ways and means to invest directly in Proven or Portland JSX, etc.
All right, so if I'm a person watching this who does not have a pension fund through my company, the company doesn't offer a pension plan, how do I as an individual start a pension plan, number one? And number two, do I have to be resident in Jamaica? Can I be a Jamaican in the UK, Canada, the US, earning some money up there and decide, you know what, I don't want a 401k, I want to invest some of that money through a pension plan in Jamaica?
So that's a good question. So in Jamaica, outside of the employer, and not all employers offer a private pension plan. And you have employers who will offer a private pension plan, but not all of their staff can join that private pension plan. And you also have those that are outside of the traditional employer sphere. Now, those that are outside of a traditional private company offered pension plan are your approved retirement schemes. So it's like your Proven Rock, your Scotia Bridge, your MCB, Smart, your Barritas, your JN. So a lot of securities dealers in Jamaica offer approved retirement schemes. The last time I checked, there were 13 of those in Jamaica.
Wow.
So they're not short. One could argue that, you know, the visibility of it and the advertisement of it may need improvement, but they're not short. So persons who are not a part of a pension plan now can engage any one of these persons in entities that offer these pension scheme arrangements, find out how they can join. I mean, even if they work with a company, they can arrange for salary deduction. You can contribute up to 20% of your income into our approved retirement scheme, as opposed to just sitting down and saying, I don't have any options, I don't know what to do. That doesn't prevent the person also from investing in their own investment portfolio. So it's complements as opposed to substitutes.
Right.
In terms of your question about whether somebody from foreign can invest, I really not sure, to be honest.
Okay.
I think that each of these persons will have to engage these 13 companies that offer the retirement schemes to find out what their KYC policies are, your customers, how you open an account, can I invest in it, what's the mechanism behind it, and if it's possible, I'm sure they'll facilitate it. Right.
Okay, but I didn't realize there were 13.
There are options there for persons to save for their retirement. If nothing else is said, there are options there just for persons to explore and, you know, and start the conversation with these providers and see how best they can invest. And you can stop. If you lose your job and you don't have an income, then you can stop. And then when you start working again, you start again.
Okay, no, that's good to know. So you said that is up to 20% of your salary income that you can put into the RTS retirement, these approved retirement schemes. So the question is that pre-tax income? Since there's a limit of 20%. In the US, there's a certain amount I can put in per year where it can grow tax deferred. Is that the same approach here in Jamaica, or is it after tax income that I'm putting in?
A similar kind of concept. So let's say you earn $1,000. And you know, PAYE in Jamaica is computed based on your total compensation. So you have $1,000, you take off the 20%, which is $200. It goes to that approved retirement scheme. Then the other gymnastics occur, and then the PAYE is computed on that balance. So the income that you are contributing towards your approved retirement scheme or to your retirement is taken up before PAYE is computed on the amount. So it is more tax efficient to do that as opposed to waiting until you get your net salary, then take that 20% to go and buy something, because you start with less. So at retirement, you will get less. It is also tax deferred. So at retirement, there is a percentage you get a lump sum. You have the income tax threshold, and then anything after that is taxed. But at least you'll be able to invest more over the duration of your working life, so you have more to get at retirement. So it's always encouraged to start early. If you can do 20%, do it. If you can't do 20, try the 5, try the 10, do something. And don't wait until you're 40.
Yeah, we definitely don't wait until 40 to start saving for retirement. I agree with that. We need to make sure people remember that one. And then you said specifically about that tax deferred part. Starting a much bigger pool of funds is always better to start with a larger pool of funds. How much is taxes when or is it literally just based on the income, the amount, the income at that? Because you can't predict what tax rates might be at that point, and the threshold might change, so they can't plan for that part. They just
Correct. And that information is published and updated on the tax TH's website.
All right. No, that makes a lot of sense to me. Well, so here in the United States, we tend to have 401k matches at the nicest companies where I will contribute and the company will match me, say, up to 5% of my contribution. Is that something that we are seeing as a feature among some corporates in Jamaica, or have we not been doing a match type approach yet?
For the defined contribution plans offered by private employers, you find that they will do the mandatory 5% contribution and the employee does the mandatory 5% contribution. However, because the Income Tax Act allows up to 20% of your income to save towards retirement before PAY is computed, even if the employer only contributes 5%, the minimum, then the employee can contribute the remaining 15%.
The 15, and so you could get 20. So that's another way to still get to that 20.
That's correct. That's correct. For a defined benefit plan, it depends. But again, because those rules, the employer takes on the risk. You may find that some employers, depending on whether the fund has more assets than liabilities, is a contribution holiday, or you contribute the minimum amount in a given year. So you find that the matching is more prevalent in a defined contribution plan than a defined benefit plan.
No, that is great. And I love that you're talking about starting early. You want to max out your pre-tax contribution. I think too many people don't think about that. And so the financial advisors that they meet in Jamaica, whether your firm or others, I assume they're sitting down with people and explaining all of these things to try and get them to maximize that match. The contribution.
The advisory part of it is a function of the kind of plan you're in. So if you're going to an approved retirement scheme, then your financial advisor will sit down and explain to you why it's important to contribute the maximum. For a private company employer sponsored pension plan, it has a board of trustees, some administrator governance structure around it. So ever so often, probably once a year, you'll have like a members meeting and they explain the importance of trying to maximize the amount you can contribute. So information is available in different forms, but information is available so that persons can assimilate it. Interestingly though, you will find that even though the information is out there, young people sometimes they want the money and they want the money now. So they know they can afford 15%, but they see a nice car, they want to go to the party, they're living their best life right now, they're going to spend the money. No.
Right. Well, we were all young at once. Huh? We were all young one time, Marie. I like that. We were all younger. You see my gray hair? Sure enough, we were all younger at one time. Because we're still young. We hope we're looking young. And so, you know what? I want to help wrap this up. But if you could give your 20-year-old self some advice, I don't know, you look like you're about 25 now, but if you could give your 20-year-old self some advice, what one bit of financial advice would you give your 20-year-old self, Marie?
So I would say balance is important. Start investing early. Even if you don't start saving for pensions later, start investing early. And don't limit your investment to just the traditional. If you can buy real estate early, buy the real estate early. If you can buy the stocks early, buy the stocks early. Also, when you are looking at investing, keep focus over time on what the inflation rate is in any economy. Your inflation rate, everybody hear it from the shoulder off, keep moving, it's eat out your money. So if you're investing early, make sure you're getting a return that is at least inflation. Jamaica now, the targets are around 4 to 6%. If you're not getting 4%, 5%, 6% or above that over time, look back at what you are doing. Balance, invest. Live your life, invest. Because we're all living longer. We can't be retired and broke. We can't be retired and relying on our kids to take care of us. We don't have children as much as before to take care of us in old age pension.
You're not gonna make you say that again. You don't want to be retired and broke.
You cannot be retired and broke. It's not cute.
It's not cute at all. It can't work. No, I love hearing this, and I love that you brought up the inflation part. I think not enough people pay attention to that. Yeah, I remember I was in a webinar recently, an investment webinar, and they were talking about in Brazil, and I said, hey, so I met some fund managers in the US who invested in Brazil in private equity. And after the 10 years in Brazilian dollars, their returns look amazing, amazing IRRs. And then when they convert to the US dollars, they lost money. Every single one of them lost money because inflation, they weren't paying attention to that. So that is such an important point. Thankfully, Jamaica now has, low and stable inflation.
Stable inflation, yeah.
Yeah. I went to high school in the 1990s and I was tracking inflation with patties. And every time I'd go to university and I'd come back to Jamaica, I'd buy a patty and I'd take a picture of the receipt and post it on Facebook to track how the dollar was moving.
Yes.
So I'm glad to see that we have far less worry now about inflation. Interest rates have come down. But this has been great. I think you shared some amazing advice for people in Jamaica, as well as those of us outside who didn't realize how advanced Jamaica is in terms of the pension industry and the fact that we have the approved retirement schemes outside of what might be available in our company. A lot of people probably didn't know that you could do up to 20% pre-tax. So this is great. I thank you so much for sharing this information. And as we say, young people, we should say the younger people tend not to read, but you're doing it where they are. You're doing this on social media. So hats off to you and the Piaj team for meeting them where they are.
Yes. And from a Piaj perspective, we're trying to improve the education of our pension. We realize that that's an area that needs improvement. So we can have all the fancy reforms in the world, but if the persons are not following, then we're going to end up later on still being retired and broke.
All right. Well, I'm going to leave with one last question then. So I see how BOJ bust them thing and have big music video to talk about inflation. When Piaj going to drop a music video and I don't play it.
I will defer the question to the president.
I will talk to Sanya. Yes, let's go. Thank you so much, Marie. This was a lot of fun. I can't wait to meet you in person.
Same here. All right, David, take care. Yeah, man, bye.
Thank you. No problem.
Bye.